For decades, the US dollar has stood as the bedrock of the global financial system, the unchallenged reserve currency. Its ubiquity in trade, finance, and central bank reserves has granted the United States immense economic and geopolitical leverage. But now, that dominance faces increasing scrutiny. From geopolitical shifts to burgeoning economic blocs, a chorus of voices questions whether the dollar's reign is sustainable. This deep dive will analyze the forces at play, examining the historical ascent of the USD, the contemporary challenges it confronts, and the potential ramifications should its status falter. Is the dollar dying? Or is it merely adapting to a new world order? The US dollar's journey to global supremacy began in the aftermath of World War II. In July 1944, delegates from 44 Allied nations convened at Bretton Woods, New Hampshire, to establish a new international monetary order. The devastation of war had left European economies crippled, positioning the United States, with its intact industrial base and vast gold reserves, as the dominant economic power. Under the Bretton Woods Agreement, the US dollar was pegged to gold at $35 per troy ounce, and other currencies were then fixed to the dollar. This established the USD as the anchor of the international financial system. This direct convertibility to gold was the cornerstone of the dollar's early credibility. Central banks worldwide accumulated dollar reserves, confident in their ability to exchange them for physical gold. As economist John Maynard Keynes famously noted, the system aimed to avoid the chaos of the interwar period. The dollar became synonymous with stability and reliability, essential traits for a reserve currency. It facilitated international trade, provided a stable unit of account, and became the preferred medium for settling cross-border transactions. This era solidified the dollar's role, backed by both the economic might of the US and the perceived security of gold. The gold-backed system, however, proved unsustainable. Mounting U.S. budget deficits from the Vietnam War and domestic spending, coupled with a growing balance of payments deficit, led to increased demands by foreign central banks to convert their dollars to gold. The U.S. gold reserves dwindled. In a pivotal move on August 15, 1971, President Richard Nixon unilaterally announced the suspension of the dollar's convertibility to gold, effectively ending the Bretton Woods system. This Nixon shock transitioned the world to a floating exchange rate system, where the dollar's value was no longer tied to gold, but rather to market forces and confidence in the U.S. economy. Despite severing ties with gold, the dollar quickly found a new anchor: oil. In the early 1970s, amidst rising global oil demand, the U.S. negotiated a series of agreements, most notably with Saudi Arabia. In 1974, a landmark deal orchestrated by then-Secretary of State Henry Kissinger ensured that Saudi Arabia would price its oil exports exclusively in U.S. dollars and invest its surplus oil revenues into U.S. Treasury securities. Other OPEC nations soon followed suit. This pivotal arrangement created the petrodollar system, cementing the dollar's necessity for any nation requiring oil, effectively globalizing its demand regardless of its gold backing. The petrodollar system had a profound impact, fundamentally linking global energy markets to the U.S. currency. Nations needing oil had to acquire dollars first, creating constant international demand for the USD. This recycling of petrodollars into U.S. assets, such as Treasury bonds, also helped finance U.S. budget deficits and kept interest rates lower than they might otherwise have been. According to a 2022 analysis by the Federal Reserve, the petrodollar mechanism reinforced dollar liquidity in global markets, making it easier and cheaper for countries to trade, invest, and maintain reserves in USD, thereby strengthening its reserve currency status long after gold convertibility ended. Today, the dollar's dominance remains largely undisputed in several key metrics. Data from the International Monetary Fund, IMF, indicates that the US dollar constituted approximately 58.4% of global foreign exchange reserves in the fourth quarter of 2023. This far outpaces rivals like the euro, which holds around 19.8%, and the Japanese yen at 5.5%. Furthermore, according to SWIFT data, the dollar facilitates nearly 47% of all international payments. Approximately 80% of global trade invoicing, particularly for commodities, is denominated in dollars, making it the unavoidable medium for vast swaths of international commerce and finance. However, this dominance is not unchallenged. A significant countermovement is emerging from the BRICS nations, Brazil, Russia, India, China, and South Africa, with recent additions including Egypt, Ethiopia, Iran, Saudi Arabia, and UAE. Formed in 2009, BRICS initially aimed to foster economic cooperation among major emerging economies. In recent years, their agenda has expanded to explicitly challenge the unipolar global order centered on the US dollar. Their shared goal is to create a more multipolar world, economically and politically, which inherently involves reducing reliance on the dollar. This initiative is largely driven by a desire for greater financial autonomy and reduced vulnerability to US sanctions. BRICS nations are actively pursuing strategies to lessen their dependence on the dollar. According to a 2023 report from the Russian Ministry of Finance, these efforts include increasing bilateral trade settlement in local currencies, bypassing the dollar entirely. China and Russia, for example, have significantly ramped up trade using the yuan and ruble since 2022. The New Development Bank, NDB, a BRICS initiative, aims to offer loans in local currencies, reducing the need for dollar-denominated financing. They are also exploring the development of a common BRICS payment system, potentially an alternative to SWIFT, to facilitate these non-dollar transactions. Central to China's de-dollarization strategy is the advancement of its digital currency, the digital yuan or ECNY. Unlike decentralized cryptocurrencies, the ECNY is a central bank digital currency, CBDC, controlled by the People's Bank of China. The aim is to streamline domestic payments, but its long-term potential for international trade is undeniable. Experts at the Atlantic Council's Geoeconomics Center suggest that the ECNY could offer a direct settlement mechanism for international transactions, bypassing the traditional dollar-denominated financial system. While it currently faces hurdles in global adoption, its development signifies a deliberate move to challenge the dollar's role in digital finance. Following Western sanctions imposed after the 2022 invasion of Ukraine, Russia significantly accelerated its de-dollarization efforts. Its access to billions in dollar-denominated reserves was frozen, prompting a strategic shift. According to the Bank of Russia, the country drastically reduced its dollar holdings and dramatically increased its gold reserves. Furthermore, Russia mandated that unfriendly nations pay for its natural gas exports in rubles, effectively demanding local currency for a key commodity. This move, while controversial, served to boost demand for the ruble and further decouple Russia's economy from Western financial systems, albeit at a cost to its own economic stability. Even the foundational pillar of the petrodollar is showing cracks. Saudi Arabia, the long-standing linchpin of the system, has indicated a willingness to consider non-dollar currencies for oil sales. In early 2023, Saudi Finance Minister Mohammed Al-Jadaan stated that discussions about alternative currencies are a possibility, signaling a departure from its decades-old exclusive dollar policy. While no definitive deals have been announced, this shift reflects Riyadh's broader diplomatic realignment, particularly with China, and its desire for greater strategic flexibility. Any significant move by Saudi Arabia to accept other currencies for oil would undoubtedly weaken the petrodollar's grip and diminish global dollar demand. Beyond geopolitical shifts, the global energy transition poses a longer-term structural threat to the petrodollar. As the world moves towards renewable energy sources and away from fossil fuels, the inherent demand for oil, and consequently for the dollars used to purchase it, could diminish. A 2023 report by the International Energy Agency projects a peak in global oil demand by 2030 under current policy scenarios. This transition implies a gradual erosion of the petrodollar's influence. While oil will remain vital for decades, its role as the dominant global commodity, and thus the dollar's link to it, is set to evolve, creating potential vulnerabilities for USD hegemony. The dollar also faces significant internal pressures from the United States' own economic realities. The escalating U.S. national debt, now exceeding $34 trillion, raises concerns among some investors about long-term fiscal stability. Persistent budget deficits require continuous borrowing, often from foreign investors who purchase U.S. Treasury bonds. Should confidence in the U.S. government's ability to manage its finances wane, it could impact the dollar's perceived stability. Furthermore, inflationary pressures, as seen in 2022 and 2023, can erode the purchasing power of the dollar, potentially making it a less attractive store of value for central banks and international investors. Despite these challenges, many analysts contend that the dollar's demise is greatly exaggerated. The United States boasts the world's largest and most liquid financial markets, offering unparalleled opportunities for investment and capital mobility. The dollar's deep network effects mean that even countries critical of U.S. policy often still rely on its financial infrastructure for their own stability. As a 2023 analysis by the Council on Foreign Relations highlighted, there is no single, immediate, and viable alternative to the dollar that possesses the same scale, liquidity, and trust. The euro faces internal political divisions, while the yuan lacks full convertibility and independent judicial oversight, hindering its global appeal. The future of the dollar likely involves a spectrum of possibilities, rather than a binary outcome of dominance or collapse. Experts at the World Bank suggest two main scenarios: a gradual erosion or a rapid, disruptive shift. A gradual erosion would see the dollar's share of global reserves and trade slowly decline as other currencies, like the euro or yuan, gain traction in specific regions or sectors. A rapid shift, though less likely, could be triggered by a major geopolitical event or a severe U.S. economic crisis, leading to a sudden loss of confidence and a scramble for alternatives. Most forecasts lean towards a more multipolar currency system, not necessarily a dollar collapse. Should the dollar lose its status as the primary global reserve currency, the consequences for the U.S. economy would be profound. Economists at the Peterson Institute for International Economics warn of several impacts. The U.S. government would likely face higher borrowing costs as demand for Treasury bonds decreases. The exorbitant privilege of being able to finance large deficits relatively cheaply would vanish. American consumers would experience higher import prices, leading to inflation, and the cost of foreign travel would increase. Furthermore, the U.S. would lose significant geopolitical influence, as the ability to wield financial sanctions and dictate global economic terms would be severely curtailed. Globally, a diminished dollar would usher in a more fragmented and potentially volatile financial landscape. While it might empower emerging economies with greater financial autonomy, it could also lead to increased exchange rate volatility and higher transaction costs for international trade, at least initially. The International Monetary Fund suggests that a multipolar currency system, if managed well, could foster greater global financial stability by diversifying risk. However, it also carries the risk of economic blocs becoming more insular, potentially leading to trade wars and reduced global cooperation. The transition would be complex, reshaping trade flows, investment patterns, and geopolitical alliances. So, is the US dollar dying? The evidence suggests a more nuanced reality. While its unchallenged dominance is being tested by geopolitical ambition, economic diversification, and technological innovation, its entrenched position and the lack of a clear, single alternative make a rapid collapse unlikely. What is clear, however, is that the dollar's future will be one of increasing competition and adaptation. The world is moving towards a more multipolar financial system, where the dollar, while still powerful, may share its throne with other currencies and digital assets. The ultimate outcome hinges on a complex interplay of economic policy, geopolitical strategy, and the evolving trust of global actors in a new era of finance.